going the road. So before we get to our featured guest today, Dr. Kevin Gillen from Drexel University, I have a couple of announcements. Hopefully everybody has received emails from us about GPAR's Easy Pay plan. It's a really great feature for our members to have, where you're able to spread your payments out in advance of January. And we started that program now. So it's not maybe something for everybody, but is a great option for some of our members. So if you have any questions about that and you want to enroll in the plan, check your emails or give a call to Charlotte Corman or shoot Charlotte an email. Charlotte's from our team. She handles all that stuff. Again, it's a great opportunity to spread out your payments in advance of January. Hopefully also too, you've seen this in the other emails about continuing ed and license renewal. The deadline is rapidly approaching. It's Saturday, August 29th. If you've been having trouble trying to get into the PAL system, please be patient. It's important to remember also too, that is the state. The state government runs that, not GPAR, not PAR. If you have any questions or need some guidance, you can reach out to our office, or also to communication has been going out from PAR as well. Again, PALS is run by the Department of State from Pennsylvania, and you know, they're working remotely, and there's definitely some problems. So stick with it, get your stuff in the queue there. And the communication that's been coming from PAR, make sure you read that, or if something changes, we'll be sure to send out a message as well. One of our features that we have on Mondays from time to time is Coffee Talk with our president, Stephanie Biello. We're pleased to announce to everybody that on Monday, August 31st, we're going to have Councilman Alan Dom as our guest on Coffee Talk with Stephanie. It's very timely to have him come in for a cup of coffee with us, because City Council will be starting the following week on September 10th. That's a Thursday. So he's going to give us a little bit of insights about what has transpired since Council last met back in June, what he foresees in the coming months. There's probably going to be a very busy fall for City Council, because a lot of bills were put on the back burner because they were strictly dealing with things related to the pandemic, so, and the city budget. So very timely to have Councilman Dom come in and speak with us. We have other stuff that's getting lined up for September, so keep an eye on your inbox and social media platforms for communication from GPAR. So with that, I'd like to go ahead and get started with the main feature of today, and that's the economic update from Dr. Kevin Gillen. If you could please keep your questions till the end. He's going to roll through his presentation, and then when we get to the end, drop in your questions into the chat box, the chat feature, and then we will start rolling those questions out to Dr. Gillen. So with that, I'm going to try to pull up his PowerPoint slide, and I will be the guy who advances the slides for him. So hopefully we can make this work for everybody. And let's see how I do this. Okay, can you guys see that? Cool. All right, the floor is yours, Kevin.
All right, thank you very much, Matthew. All right, so I hope everyone's doing well and holding up during these challenging times. So the presentation today will not be especially long. It's just going to basically be based off the quarterly reports that I produce and delivered in a summary way. So our housing market, where are we, and where are we headed, especially given the volatility of recent months. So next. All right, so first we'll start with house prices. Okay, next. All right, so here's my house price index for Philadelphia. It represents the change in the general level of house prices over time for the city. It's got a starting value of 100 in the year 1980. And you can just think of it as a Dow Jones index for the value of the typical Philadelphia home. So you can see the big spike in the middle. That was the housing bubble years of the mid-2000s. Then from 2005 to 2007 to 2012 was the drop. That was the bursting of the bubble. Since then, house prices in the city have done quite well. They've risen 58% since hitting bottom in 2012 when the current expansionary market began. They rose this spring. You don't see any dip there, despite the tumult. And now house prices right now are actually now 26% higher than the previous peak back in 2007, before the previous recession and downturn. Next. Moreover, the city's prices, just the actual median house price, is at an all-time high and broke a record this spring, believe it or not. The median house price in Philadelphia crossed $200,000 for the first time ever in history this past spring, despite the tumult of things. The red line represents my house price index. The blue line is just literally the median house price in the city. So I take every home that transacts, and the median price is the point at which 50% of homes transacted for more than that and 50% transacted for less. You'll notice that the blue line has a lot more volatility in it. That's just the seasonality and noise in raw house prices, which my regression eliminates. But you also notice that ever since the housing bubble years, the blue line has been rising faster than the red line. And that's because raw house prices in the city, with the addition of so much new construction, if you don't control for that sort of sample selection bias in the data, prices will look higher than they actually are. But still, median house prices rose this spring and they crossed $200,000. The median house price now in Philadelphia is just over $200,000. The last time it crossed $100,000 threshold was way back in 2004. So, hey, you know, a landmark. Next. And the city has outperformed the suburbs during the current expansion, and especially even during this past spring with everything that's been going on. So the green line represents the house price index for the Philadelphia suburbs. So I compute that in a separate report, the same way I compute my price index for the city, which is the red line. And then the dark blue line is the house price index for just the entire US. It's published by the federal government, just so you can see how our city and region are doing compared to you know, national trends. And as you can see, up until about 2007, the red line was below the green line, which means that basically city house prices were chasing suburban ones. We never caught up. But then during the current expansion, city prices have been outperformed suburban prices by a very, very large margin. I want to point out that does not mean that the general level of prices in the city is higher than the suburbs. It is not. City prices are still below suburban prices. What it means is that city prices have been rising faster than suburban prices. And if you notice the dashed line there where it says Q2 is how prices did this past spring. You can clearly see prices rose in the city, whereas they actually dipped rather significantly in the suburbs during the past several months. Next. And here's a map showing the year-on-year house price rate of change by county in the region. And each county is extruded by how much the general level of house prices changed over the course of the last 12 months. And you can see Philadelphia in the center basically levitating over all its suburban counties. The general level of house prices in every suburban county actually fell over the course of the past 12 months, but they rose in Philadelphia. The general level of house prices in Philadelphia is up about 9% from a year ago. Just to give you some context on that, the historical rate of appreciation of house prices in Philadelphia is about 4 to 5% per year. So if you just buy the average Philadelphia home, it'll give you a return of about 4 to 5% per year, historically speaking. We're at about almost double that over the last 12 months, and that's including the sales data from the last 3 months, which of course includes the pandemic and the social unrest. So city up, suburbs down. Next, we'll get to why that is, because I'm sure some of this is rather unexpected. Another landmark that we crossed this past spring is that the median house price in Philadelphia passed the median house price in Camden County. That may not seem remarkable, but if you look at the history of house prices in the region, this goes back to 1980. This is just the median house price in every county, and I took a 3-month smoothing average to get rid of all that seasonal noise. You see the red line at the bottom is the median house price in Philadelphia County. We were the lowest priced county in the entire tri-state area up until 2015 when we passed Salem County. And then this past quarter, we passed Camden County. So we are now only the 3rd lowest priced county in the entire region out of the total 11 counties that are included in this analysis. Next. There is significant spatial variation in prices, however, across the city. This map color codes home sales in the most recent quarter by the price per square foot. 20% of all home sales fall into each of the 5 categories. So if you look at the price per square foot legend on the lower right-hand side, the dark blue dots represent homes that transacted at $80 a square foot or less. That's the bottom 20% of the market. The next 20% of the market are homes that sold between $80 a foot and $130 a foot, so forth and so on. And then the top 20% of the market, the red dots, are homes that sold at a price point of $240 a square foot or more. And you can see the clustering in and around Center City, particularly as it's spread out towards Fairmount, The lower river wards in Old Kensington, Fishtown, starting to get into Port Richmond. South Philadelphia, as you can see, is almost all red right now. It's only the very outer periphery of South Philadelphia is still the old South Philly. Then you can see the lower income, lower price parts of the city of, West Philly, North Philadelphia, and of course the lower Northeast. East Falls also showing a cluster. It's turned red recently. It used to be not so hot, but that appears to be growing as well. Next. Okay, so that's prices. Sales, however, are a bit of a different story. They did fall very sharply this past spring. So this shows just the number of homes that transacted in Philadelphia in each quarter from 1980 through the current one. As you can guess, there's also strong seasonality in home sales. They tend to, rise during the warm weather months and fall during the cold weather months, regardless of overall market conditions. And they fell quite sharply this past spring in the city. If you look all the way to the right, you can see that blue bar and how it's fallen so sharply from Q1. It's also fallen quite sharply from a year ago. The last time we had so few homes change hands in the city, which is just over 3,000 homes, was back during the recession back in 2011. The dip is notable, of course, because not only is it down year on year, but it's also down on the quarter. And like I said, house sales activity almost always rises from Q1 to Q2 as you go from winter to spring, because the warm weather just favors, home sales activity and showings. And it actually fell from winter to spring. Obviously, the pandemic is a huge factor in there, especially since it, as you know, sales activity was limited. Being able to show homes was not considered an essential business activity. So a very large dip in home sales, I'm sure, to no one's surprise. Next. $1 million home sales actually held up fairly well, though. They actually rose from Q1 to Q2. They're down on the year, but they've held fairly steady compared to the level of overall home sales during this pandemic so far. Next. And if we look at condo sales, again, we see a similar pattern. A big drop in condo sales in Philadelphia County this past quarter. Not only are they down on the year, but if you look all the way to the right, you'll see they actually dropped from Q1 to Q2 as well. And again, they really got hit hard. Only a little over 300 condo sales this past quarter, because again, not only were showings restricted and sales business activity restricted, but during the pandemic, which is not over, but during its peak, a lot of people, I think, are a lot less comfortable going into a high density building and riding an elevator if they're concerned about the possibility of contagion. Right, next. $1 million condo sales, however, actually, again, did pretty well. They rose from Q1 to Q2. They're down on the year, but we had nearly 30 condos transact at a price point of $1 million or more this past quarter, which is pretty good considering, I think, the prevailing conditions that they had to work against. Next. All right, so that's where we are. Let's talk about where we're headed. Next. All right, so one of my favorite leading indicators for the market is inventories. As you all know, they're at very, very low levels right now. So this shows the number of homes listed for sale in Philadelphia County going all the way back to about 2001. You can see the huge surge in inventories back in 2004, 2005, when the housing bubble began to peak out. The inventories began to rise. And right now they're at all-time lows, and they just keep dropping. I mean, almost inexplicably. Every quarter they seem to set a new record low. Right now we have less than 3,000 homes listed for sale in the city. The absorption rate is, however, quite high because supply is so low. So even if sales are flat, but the supply is low, that blue line, the absorption rate, the percent of homes listed that actually sell, is fairly high. So right now, in any given month, about 30% of homes listed for sale in the city are selling. Historically, it's more like around 20% would be the average absorption rate for the city. But with such times of such low supply, we've got a very high absorption rate. But again, these inventories are important because I think it's one of the key reasons that they're putting some significant upward pressure on house prices because supply is so low. Next. So then we've got the month supply of inventory in Philadelphia. This is the number of months it would take to burn off the current supply of homes listed for sale. As most of you know, a 5 to 7 months supply of homes is considered a balanced market. Anything more than 7 months is a buyer's market. Anything less than 5 months is a seller's market. And as you can see, we're deep into a seller's market right now. The negotiation conditions and terms and the prevailing economic environment heavily favor sellers over buyers. And again, I think that because sellers have so much leverage, generally speaking, over buyers due to the low supply, is one of the reasons we're still seeing these increases in house prices, rather than house prices increasing due to just more market fundamentals such as growing incomes, growing population, things like that. Next. However, in the suburbs, low supply has been less consistent. So this shows the month supply of inventory in the suburbs. It doesn't go back as far in time because the data just doesn't do that. Again, the suburbs are in a seller's market, but if you look at the bars, notice they dance back and forth between being in a balanced market and seller's market, especially over the last few years. So I think that even though, again, supply is also low in the suburbs, it hasn't been as consistently low or as absolutely low. And I think that's one of the reasons why we've seen, house prices in the burbs being cooler than they are in the city where they've been quite hot. Next. Also, is the pace of sales slowing? This shows the average days on market for Philadelphia homes. Again, that swings around wildly from month to month, so I just fit a polynomial spline through it to just get a general trend. And as you can see, it does appear to be increasing. Again, days on market tends to be a pretty good leading indicator of the overall market. It's a leading indicator for prices and sales. And days on market tends to rise when you're entering into a bear market. So that's another indicator I'm keeping an eye on. Next. Building permits in the city, however, have taken a real hit. Forgive the title, there's a typo in it. It says residential building permits in 2019 Q3. I just updated an old slide. It's through 2020 Q2. So this shows the building permits issued in Philadelphia for residential construction. So the purple component is the number of single-family units that have been approved for construction, and the green component is the number of units that have been approved in multifamily construction. So again, you can see new home construction in the city is, again, cyclical, just like prices and sales are. You see the big surge back in the mid-2000s, and you see the crash, after the housing bubble burst and the Great Recession. And then you see the current surge. We built more units during the current expansionary market than we did during the last cycle, which was, again, known as the housing bubble. But again, you see the big dip from 2019 to 2020. Now, you're probably thinking, yeah, but 2020 is not over yet. You're right. The 2020 numbers are annualized. That is, what I did is I took the number of permits that were approved through June, and then I multiplied that times 2, because June is just covers 6 months out of 12 months. So if at the current pace of approvals, given the current pace of approvals of residential building permits in Philadelphia, we're only on track to add 2,300 new units to our housing stock this year. You can see that's a big drop from 2019, and is the lowest level going back to 2012, which is actually when the current expansionary market began. Part of that, I'm sure, is the pandemic. Part of that, I'm guessing, is civil unrest. But the other big piece, as you all know, is the 10-year tax abatement. That took effect, the changes to it took effect January 1st. The tax benefits of the abatement have been significantly curtailed. And here you see home builders reacting to that. All right, next. Foreclosure rates, however, are down dramatically, but there's a reason for that. So across the state and in Philadelphia County, foreclosure rates have plummeted. 6 months ago, about 1 in every 2,500 homes in Pennsylvania was in foreclosure. Right now, only 1 in every 13,000 homes is in the process of foreclosure. In Philadelphia, the numbers have gone from 1 in every 1,500 homes being in the foreclosure process to 1 in every nearly 15,000 homes being in the foreclosure process. But as you can guess, this is not an improved market. It's because there's a moratorium on foreclosures and evictions statewide. So this is putting a real cap on foreclosures in the pipeline. And I'm concerned about what is going to happen once that moratorium is lifted. By the way, this is not a local trend. It's a national trend. About half the states in the U.S. have imposed a moratorium on foreclosures. If you look at the chart on the lower right-hand side, you'll see the number of foreclosures nationally. The blue line is pre-foreclosures, yellow is auction, red is bank-owned, and you see the huge drop from March to April when the moratorium was imposed nationwide. And again, one of the reasons I'm concerned about this is because, next, foreclosures may be down, but mortgage delinquencies are way up. So this compares, I apologize for the fuzziness of this picture. But this shows mortgage delinquencies and foreclosures in the United States. This is from our friends at the Mortgage Bankers Association. The red line is homes in the foreclosure process. Red bars, the homes in the foreclosure process. And then the blue and yellow bars are homes that are mortgages that are delinquent. So you see the big spike in foreclosures during the housing bubble years. You see around 2009, 2010. And then, of course, they're declining. And, of course, you see the bar all the way at the right. It just jumps right out at you. There's a huge jump in delinquencies, even though there was a significant drop in foreclosures, which tells you that, there's a lot of, properties that would normally be in the foreclosure process, but they're not right now. And when that moratorium is lifted, I am concerned about what's going to happen when that dam breaks and you get a whole flood of foreclosed properties onto the market. Next. So then with a data point that's some good news, though, the stock market has become relatively bullish on housing as of late. This is the Philadelphia Stock Exchange Housing Sector Index. It's a modified cap-weighted index that's composed of 20 major publicly traded companies that are in housing. So it includes most of the major home builders, major mortgage lenders, title insurance companies, suppliers of construction materials, things like that. You can see the housing sector index took a huge drop in the spring from March till about May. But starting in June, it's rebounded quite significantly. It's recovered almost all of the losses that occurred this past spring. So insofar as the stock market seems to be concerned, most of the damage to housing, they think has already been capitalized into the market. So it's not that they're not expecting any further downturns. They just think that most of the damage has already occurred. I don't know if I agree with that or not, but that's what the market is saying right now. Next. All right, so to sum this up, what to expect? So prices, they have generally held up so far, but I think there's several reasons for that. One, we've had very low inventories, especially in the city. Number two, we've had very low interest rates. Also, anecdotally, I'm hearing, and I would love to hear from you on this, we may be benefiting from a New York exodus. We know there's a big outflow from New York. I have no hard data showing if many of them are landing here, but I've heard anecdotally that we have investors buying up income properties and renting them out to New Yorkers who want to ride this thing out here in Philadelphia, or even considering moving to Philadelphia. On top of that, I didn't put this bullet point there, but I know that there's sample selection bias in the home sales data. Whenever you have a market downturn, the first people that get cut out of the market are your lower income and first-time home buyers. So the home sales that have occurred have been disproportionately skewed towards the upper end of the market. And so I think they're sort of misrepresenting the general level of prices. It's kind of like, if only Cadillacs are selling and Hondas aren't selling, well, car prices will look high, right? Well, if, no first-time home buyers and low-income home buyers are cut out of the market, prices will look higher than they are because only higher-priced homes are transacting. And then lastly, one thing I'd like to point out, a silver lining here for housing in the times of the pandemic, is that telecommuting actually supports house prices. If people have to work from home and they're not working in an office, then basically you've upzoned a single-family residence into a commercial mixed-use property, and that would increase its value. If people have to work from home, and a home is not just someplace you live and play, but also someplace you work, well, your demand to stay in that home is that much higher. So, insofar as your income starts to take a hit, you still need someplace to work, so you're more inclined to do what you can to stay in that home. So, believe it or not, there is a silver lining to the pandemic, and that telecommuting is supporting house prices, even if at the expense of office rents and prices. The commercial sector, I can tell you, is facing its own serious challenges right now. All right, so the prices have held up so far. Next. But remember, the general level of house prices moves fairly slowly, especially in reaction to events. As you're the last people I need to explain that it usually takes, a month or so to move a house. So house prices tend to be very much a lagging indicator of current events. Sales, as you can see, have reacted much more quickly to the pandemic and associated unrest that's followed, and they are generally down. So sales, have become more bearish than house prices, and they've reacted more quickly. So going forward, what can we expect? Well, eventually inventories are going to have to start to rise. I mean, they just cannot stay this low in perpetuity. Eventually they'll have to start to rise. And I imagine as some people get squeezed by, current economic conditions, eventually they'll have to sell their house and consider downsizing or renting. So inventories will start to go up. And then the big trigger event I'm worried about is once the moratorium is lifted on foreclosures. Once that is lifted, you see all those homes that are delinquent, are going to get served with papers, and I presumably they'll enter the foreclosure process. And that's also going to add inventory. So you could end up getting this sort of cascade effect that once the supply of homes starts to rise, it will rise at an exponential rate. I don't know that that's going to happen, but I am concerned there's a non-trivial probability of that happening. So those are the numbers I'm keeping my eyes on. Next. So to wrap this up, we've weathered the events of the past few months relatively well, but we're not out of the woods and there's more to come. So please, until we get to the new normal, I wish you all the best in trying to get through the current new abnormal. And with that, I thank you very much for your time, and I'd be happy to take any questions.
Okay, Kevin, thank you very much for running through all those slides with us. As you guys start to get your questions into the chat, I just wanted to throw one more reminder out as it relates to training opportunities for our folks, and that's Bright MLS. We're lucky to have Julie with us from Bright on this chat right here. She's waving in a very friendly way to all our folks. Keep an eye out for Bright trainings, as well as messaging from us about those upcoming trainings. Really great stuff. They put together some really awesome things for us during the course of this pandemic, and they continue to do so for us. So thank you, Julie. Thank you to Bright MLS. So we're going to go into the chat, see what questions that we have. And the question that we have, Kevin, is do you see, during your spring market update, you mentioned that you foresee going into a recession at the end of 2020. Do you still see this?
Well, basically, we're already in one, at least mathematically speaking. The agency that is in charge of declaring a recession is the National Bureau of Economic Research. And the definition of a recession is when you have 2 consecutive quarters of negative GDP growth. We know we've already had one, this quarter ends, in September, and I would imagine it's going to be negative as well, and they'll officially be calling it a recession. Now, whether our housing market will be officially in a downturn and we'll see dropping house prices, I have to imagine we're going to see some cooling at some point because, like I said, I think that the recent increases that we've seen, especially this past spring, which were some sharp increases, were synthetically driven rather than organically driven. We've had low inventories, we've had sales skewed towards higher priced homes, and we've also had if we have New York money coming in, they're going to bid up house prices as well, just because they have higher incomes. So I'm happy that house prices have held up, but insofar as house prices rise, I want to see it rising for the right reasons. I want to see house prices rise because we're growing in population, incomes are rising. The city is doing better. It's a more desirable place to live. If prices are rising just because there's a synthetic shortage of supply or sales data is skewed towards higher income households, then eventually they're going to come back down. And, we don't want to see that happening either, since homes are a store of wealth for so many people in the city and their primary asset.
Kevin, do you see any impacts from the potential government interventions? So Washington, D.C. is contemplating another package, and then who knows what's going to be happening with the city budget going forward. What kind of impacts do you see from the local and federal governments impacting on the marketplace?
I would prefer to see the federal government directly helping out the states and cities rather than just issuing checks. I'm sure the average person probably doesn't feel that way, but the cities and states are going to take a massive hit. They already are taking a massive hit on their budgets due to the pandemic and the social unrest. And we're about to face a major shortfall in funding for our public services here in Philadelphia and in other cities. Most cities are funded by the property tax. So those cities that are experiencing exodus, like New York, Minneapolis, Seattle, are already taking a big hit. But in Philadelphia, we're weird because, as many of you know, we rely primarily on wage and business taxes rather than the property tax. So our house prices have held up so far, so that's good. But the thing is, most of the city's revenue doesn't come from the property tax. It comes from wage and business taxes. Well, guess what's not happening right now? People aren't working and businesses aren't open. So wage and tax revenue has not only taken a massive hit, but wage tax revenue and business tax revenue reacts much more quickly to events than property tax revenue, because your property tax is based upon an annual assessment. It takes a year for assessments to be reset. So property tax revenue doesn't bounce around like crazy, but wage and business tax revenue, if sales activity is bouncing around and employment activity is bouncing around and businesses are being shuttered, that revenue drops really fast, and it already has. So I am very, very concerned about the budget shortfall we're facing. I'm sure Councilman Dom will have more to say about this at Coffee Talk next week, but I would encourage you to tune in to hear about that, because one of the biggest factors that supports housing demand and house prices is the quality and quantity of public services. And if you can't fund those services, you better bet it's going to affect the housing market in the city adversely.
Okay, so we have a question in the chat that relates to the market and using an example here. So I noticed that homes closed around 1.5 million in Society Hill sold for slightly less than the same homes sold in 2006, 2014, and 2016. This market feels softer to me. Any thoughts?
So the question is the Society Hill market softer now than it was 10 years ago?
I guess you could distill that. Yep.
I can't say as I track the micro markets that closely. I do produce sub-market indices for the city. I have a separate index just for Center City, but I don't have one for Society Hill. I can tell you that Center City transactions have been decent, but compared to what's been going on citywide, Center City house price trends have actually been fairly flat. They're up, but they're up by a much more modest amount than we're seeing in other areas. And the reason being is twofold. One, Center City is already the highest priced market in the city. So even if house prices go up by, pick a number, $50,000 per year across the city, that's a much smaller percent increase to center city than it would be to, say, North or West Philadelphia, because the general level of house prices is low. Moreover, the reason we've seen a higher rate of house price appreciation in the other neighborhoods is because that's where the revitalization or gentrification has been occurring. I mean, center city is basically as gentrified as it gets. But when you see the big surge in house price appreciation due to a neighborhood transitioning upwards, I'm thinking of course, the fish towns, basically almost all of South Philly, places like that. That's where the greater rates of appreciation have been.
Okay, so folks, just a point of note. Yes, we are recording this, and we will be sending out a link to our members once that is all uploaded. So keep an eye on future email correspondence from GPAR for that link of today's presentation. So we have a couple questions related to the rental market, Kevin, and that's getting into, do you have any data on the rental market? Where do you see high-end rentals versus moderate rentals? So a few folks asking about the rental market.
Yeah, I don't claim any special expertise in the rental market. I just don't follow it as closely as I do the owner-occupied market. We do know that rents have softened over the last 2 years or so because there's been so much new supply coming on the market. More recently, however, I haven't seen much more softening for two reasons. Again, people are working from home now, and they need a place to do it, and that's supporting the general level of rents, just like it's supporting the general level of house prices. And again, anecdotally, we're hearing that there has been an influx of people from North Jersey and New York City area, and rather than buying, they're renting. So there has been some absorption on that end. So I haven't seen any surge or crash in the rental market. I've seen some softening followed by some recent firming up of it. That's about as detailed as I can get.
Okay, so we might be going into another area here where you might not have the direct answers to, and that's going into foreclosures and moratoriums. As we know, that's government has intervened with these issues. So do you have any idea when the moratorium might lift? And I think that's kind of sounds like it's not defined quite yet. Do you know anything about that?
Well, I'm an economist, not a political scientist, so I'm not in the business of predicting what Governor Wolf is going to do. They did extend it, I believe. It was originally supposed to be lifted on July 1st, and it was extended, I think, through September 1st, right? So I would imagine that, given the political winds and who, Governor Wolf is, he's more inclined to extend it rather than end it. I do know that Delaware has ended it. It's still in place in New Jersey. So what I would suggest is watch what's happening in Delaware right now. If you start to see a surge in foreclosures there, look at what the foreclosure rate is. And, I would imagine it would be comparable to what's going to happen here when you see the moratorium lifted.
Okay. And what kind of volume increase do you see for the inventory as an effect of the foreclosures? Any kind of numbers on that?
Given what happened during the last housing downturn 10 years ago, the foreclosure rate had a multiplier of about 1.3. So for every home that got foreclosed, an additional 1.3 homes on the market would also end up getting moved, because there's, as there's a filtering effect in the housing market. So, when someone loses their home, that adds to supply and that depresses house prices. That means someone else can end up going into negative equity on their home. They get foreclosed upon. So there's a 1.3 multiplier effect. So look at the number of homes being foreclosed in Philadelphia County. You can go to Realty Track to get that, and then just apply 1.3 to it to see what you can expect in the next few months going forward.
Okay, going back to the rental questions, and this isn't a specific question, but do you have a resource that we could refer our members to, or perhaps someone that you could suggest that we would have as a person to feature in another GPAR talk somewhere down the road?
On the rental market?
Yep.
The best source is actually Zillow. They actually have median rents by number of beds, by zip code, by month. And you can just download it for free from Zillow's site.
There we go, folks. Boom. All right, so 2020, not only known for coronavirus, but also too big election year. You see any impact from the presidential election for our area and the housing market?
Most economists in general think that where we're headed economically as well as socially, is heavily contingent upon the presidential election. It's going to have a big effect, no matter who you like or who you don't like. It's going to have a big effect. What I can tell you is this: we're not exactly. I think I'm telling tales out of school if I say we're not exactly facing a choice between Abraham Lincoln and JFK here, right? I mean, so I would love it if I had that choice, but we don't. I'm not in the position or in the inclination to provide an endorsement about which one I think is better. But what I can tell you, I am worried about, most economists are worried about, is this: that the election is not decisive, okay? If I would like to know who our president is by 6 a.m. the morning after the election by a decisive margin that no one's challenging. If we end up in a situation where we have a repeat of remember the Florida recount in 2000, but that's at a national level, and every lawyer in every state is litigating the outcome of the election, and it lasts for months and months and months, that's going to lead to a lot of social unrest. It's going to lead to a lot of market tumult and volatility, and it could lead to to even something worse in terms of violence in the streets. And even whomever eventually takes office, their legitimacy will be questioned by 50% of the U.S. population, and that would just be bad overall. As we economists like to say, markets like good news, but markets can handle bad news. What markets hate is no news. They hate uncertainty. You can handle bad news if you're trying to budget for your household, if you know explicitly what that bad news is. But if you don't know tomorrow if you're going to be employed or if you're going to get a raise or if you're going to be foreclosed upon, if your house is going to grow in value, that's just flying blind. And when people are flying blind, they can make very, very bad decisions because they don't have sufficient information to make good decisions. So I can handle whoever wins the election. I just want it done decisively, and not face a lot of social discouragement and disruption, I should say. And having lawyers determine who's going to be our next president rather than the electorate.
All right. So moving on, we were talking earlier about the impact of the modification of the 10-year tax abatement with the one graph you had. I think it was purple and green, and showing the permits being pulled. Do you think there's too much risk to start new development in Philadelphia right now? That's a heavy sigh right there.
Yeah, I don't want my friends at BIA to, I don't want to get in trouble with them. Now, we had to do a webinar about a month ago at Drexel with NBC 10 on the sort of the future of cities. And, if the pandemic is going to mean the end of cities, from now on, we're just going to be telecommuting. Everyone's going to work from home. We're all going to live in low density areas. I can tell you that the death of cities has been predicted many times before. The pandemic hit, in the great death that hit London in 1666 killed 1 in every 3 people. 1 in every 3 people. What happened? What's happened since then? London has grown. Philadelphia got slammed by a pandemic, Spanish influenza, 100 years ago. 12,000 Philadelphians died during that one. And remember that we were a smaller city then too. So not only was the absolute death toll higher than the current one, I think our mortality rate, the number of deaths is up to 1,700. We had nearly 10 times that during the last pandemic 100 years ago. What happened after that? Philadelphia grew. The 1920s was one of the best decades ever for Philadelphia housing. We built more housing in the 1920s than in any decade since, including the current one. The median year built of a home in Philadelphia is 1925. That was our high water mark. We built more homes in 1925 than we ever did in any year before that or any year since, including the current recent years. And that was just 5 years after the pandemic. Then we had, there's been other, the medical incidences since then. We had, remember when the internet was invented in the 90s, everyone was going to virtual telecommute, work from home. What happened after that? Cities still grew. So, the death of cities has been overstated and overpredicted many, many times. I'm not so worried about pandemics killing cities. They've survived that throughout the millennia. What I am concerned is about social unrest killing cities. That does kill cities, all right? When you have declining public services and rising crime, that will kill a city. If you remember, that's what happened in the 60s and 70s and well into the 80s when we had depopulation, abandonment of our homes, declining public services, people exiting the city. I have, when I teach my class on urban economics in the winter, I have Paul Levy from the Center City District come in and do a presentation. And in his slide deck, he's got all these pictures of what Philadelphia looked like in the 70s and 80s. And these 20-somethings can't believe it. To them, the only problems that cities have are the ones associated with growth, gentrification, housing affordability, parking, traffic congestion. they can't believe that cities can contract. It's just not on their radar because it's never happened in their lives. But I can tell you that insofar as the future of Philadelphia goes, we can rebound from a pandemic. What we can't is much more difficult to rebound from or to weather is a perfect storm of declining tax revenue, declining public services, and a declining quality of life.
All right. So one last question that we have in here, and we'll let you go and wrap this up. And it relates to the commercial sector of real estate. Do you have any data on commercial real estate? Do you look at that? And how does all that play out with the long range completion of large infrastructure and industrial revitalization in the city? Kind of a loaded question there. So anything related to commercial and the impact on those different areas?
Again, in the ranking of things, our residential sector has held up better than our Class A office sector. But again, compared to other cities' commercial sectors, Philadelphia's has held up much better than in many other cities. I mean, you should see what the rents in Manhattan are right now, and what a hit they've taken, and $1 million home sales in Manhattan right now, and the hit that they've taken. We still have fairly cheap land here. We've not seen any major spikes in vacancies or major drops in Class A rents in the CBD. I can tell you that a lot of the commercial brokers out in the burbs, particularly in places like King of Prussia and Exton, are actively trying to woo tenants out of Center City. But it's still too early in the process for those firms to commit. I mean, they're still under 1-year leases. A lot of the Class A tenants in Philadelphia are law firms. And they're very, very reluctant, if not unable, to relocate to the suburbs because they need to be near the courts. There's a reason much of the Class A office space on Market Street West is occupied by major law firms because it's within walking distance of City Hall and the other courts. They don't want to, these lawyers bill $1,000 an hour. Their time is very valuable. They don't want to be commuting in from Exton every day to go to court. So, I remain more bullish on housing than I do on commercial, but I remain more bullish on Philadelphia in general and our real estate market than I do many of the other cities that have either been hit much harder by the pandemic or by the associated civil unrest that's followed it.
All right, there we go. Kevin, we can't thank you enough for giving us your time, your insight, and your thoughts. This was just a phenomenal update for our folks. Good kernels of information in there, lots to digest. Again, thank you for your time, your valuable insights. I think we'll probably have to get you back in here sometime in the fall. Since
hopefully with some good news.
Yeah, we had you in the spring. This is the summer update. We'll get you in the fall. So I see another date with you in the future. So thank you very much for your time. Folks, GPAR, thank you for tuning in. Thanks for your questions. And we hope to see you on another virtual gathering somewhere soon down the road. Until then, stay safe and busy, and good luck with your business. Take care.
Thank you, Matt.
Bye.